The global economy is showing mixed signals. Some experts predict modest growth, while others warn of a possible recession. Watch on and don't skip the video, as I believe you would like to know how to prepare for it, regardless whether it will happen or better not. The world is still recovering from the pandemic. The Russia-Ukraine and Gaza wars are still causing uncertainty. These factors make it hard to predict the future. The UN predicts global growth of 2.8% in 2025. This is lower than pre-pandemic levels. The US, China, and India are expected to drive this growth. Europe and Japan will likely see slower growth. Overall, the global economic picture is uncertain. Growth is expected, but it will likely be slow and uneven. Some regions will do better than others. Unforeseen events could easily disrupt the recovery. The US economy is expected to slow down in 2025. This anticipated deceleration is causing concern among economists and policymakers alike. More rate cuts on the way? My personal opinion, and I may be wrong. SIFMA predicts GDP growth of just 1.9%. This modest growth rate is a significant drop from previous years. This is lower than the 2.4% growth projected for 2024. The reduction in growth expectations reflects various economic challenges. Several factors contribute to this slowdown. Analysts point to both domestic and international influences. Interest rate hikes by the Federal Reserve are slowing down inflation. These measures are intended to stabilize the economy. However, they are also making it more expensive to borrow money. Higher borrowing costs can deter investments and large purchases. This can hurt business investment and consumer spending. When businesses and consumers tighten their belts, economic growth can suffer. The global economic slowdown is another factor. International markets are interconnected, and a downturn abroad can ripple through the US economy. A weaker global economy means less demand for US goods and services. This decline in demand can impact American manufacturers and exporters. This can hurt US exports and economic growth. Reduced export activity can lead to lower revenues and job losses in export-dependent industries. Despite the slowdown, most economists don't expect a recession in the US in 2025. The fundamentals of the economy remain relatively strong. The labor market remains strong, employment levels are high, and job opportunities continue to be available across various sectors. Consumer spending, while down, is not collapsing. People are still spending money, albeit more cautiously, which helps keep the economy afloat. China and India are expected to be the fastest-growing major economies in 2025. India's GDP is projected to grow by a healthy 6.6%. China's growth is projected to be lower, at 4.8%. India's growth is driven by strong domestic demand. Private consumption and investment are both increasing. This makes India an attractive market for foreign businesses. China, however, faces challenges: how to boost its economy with monetary stimulus and fiscal policies. The property sector is struggling with debt. Additionally, China's population is shrinking, which could impact long-term growth. Despite these challenges, China remains a major player in the global economy. Its government is taking steps to support growth, including increasing infrastructure spending. The risk of a global recession in 2025 is a real concern, though not a certainty. Economists and financial experts are closely monitoring various indicators to gauge the health of the global economy. While some signs point towards potential trouble, others suggest that we might weather the storm. Economic indicators paint a mixed picture. On one hand, we see strong corporate earnings and robust consumer spending. On the other hand, there are signs of slowing growth in key sectors and rising inflation. Some suggest resilience, while others flash warning signs. The stock market has been volatile, reflecting investor uncertainty. Business investments have also shown signs of slowing down, which could impact future growth. One key indicator is the yield curve. This financial metric has historically been a reliable predictor of economic downturns. An inverted yield curve, where short-term interest rates are higher than long-term rates, is often seen as a predictor of recession. This inversion suggests that investors are worried about the near-term economic outlook. The yield curve has been inverted recently, raising concerns. This has led to increased scrutiny from both policymakers and market participants. However, other indicators are more positive. For instance, the labor market remains strong with low unemployment rates, and consumer confidence is relatively high. Corporate profits have been resilient. Many companies have reported better than expected earnings, which has helped to buoy the stock market. Private sector debt levels are relatively low. This means that businesses are in a better position to weather economic challenges without resorting to drastic measures. These factors suggest that the economy may be stronger than the yield curve alone suggests. It's important to consider the broader context and not rely on a single indicator. Overall, the risk of a recession is elevated but not overwhelming. The economy is facing headwinds, but there are also tailwinds that could help to sustain growth. Much depends on how current economic challenges evolve and how policymakers respond. Their actions will be crucial in determining whether we can avoid a recession or if we need to brace for a downturn. Section 5. J.P. Morgan's take, a cautious outlook. J.P. Morgan, a leading global financial institution, places the chance of a recession in 2025 at 20%. This is higher than their usual baseline of 10%. Their assessment is based on a combination of economic models and expert judgment. J.P. Morgan acknowledges the positive factors supporting the economy. However, they are concerned about the potential for policy mistakes. They believe that the new Trump administration's policies on trade, immigration, and taxes could harm economic growth. Despite their concerns, J.P. Morgan does not believe a recession is inevitable. They emphasize that the economy has proven to be resilient in recent years. They advise businesses and investors to stay informed and be prepared for volatility. Section 6. Policy uncertainty, a wildcard. One significant factor contributing to economic uncertainty is policy unpredictability. The new Trump administration has signaled potential shifts in trade, immigration, and fiscal policies. These changes could have far-reaching economic consequences. For instance, new tariffs or trade barriers could disrupt global supply chains and increase prices for businesses and consumers. Changes to immigration policies could impact labor markets and certain industries. Fiscal policy changes such as tax cuts or spending increases could affect government debt levels and interest rates. The lack of clarity surrounding these potential policy changes makes it difficult for businesses to plan and invest. This uncertainty can dampen economic activity and contribute to a slowdown. Section 7. Why being prepared matters. Whether or not a recession hits in 2025, being financially prepared is always a good idea. Economic downturns can lead to job losses, reduced income, and investment losses. Being prepared can help you weather these storms. Having a financial cushion can provide peace of mind during uncertain times. It can also allow you to take advantage of opportunities that may arise during a downturn, such as purchasing assets at lower prices. Preparing for a potential recession is not about panicking. It's about taking sensible steps to strengthen your financial position and reduce your vulnerability to economic shocks. Section 8. Practical steps, getting recession ready. There are several practical steps you can take to prepare for a potential recession. These steps are crucial to ensure that you and your family can weather any economic downturn with minimal stress and disruption. These steps involve managing your finances, diversifying your investments, and staying informed about economic developments. By taking these actions, you can build a solid financial foundation that will help you navigate through tough times. First, build an emergency fund. This is a crucial step because it provides a financial cushion that can help you cover unexpected expenses without going into debt. Aim to have enough cash saved to cover at least 6 months of living expenses. This might seem like a daunting task, but you can start small and gradually build up your savings over time. This will provide a safety net if you lose your job or experience a drop in income. Second, reduce your debt. High levels of debt can be a burden during a recession, making it harder to manage your finances. Focus on paying down high-interest debt such as credit cards and personal loans. By reducing your debt, you can free up more of your income for essential expenses and savings. Third, diversify your investments. Don't put all your eggs in one basket. Diversification can help protect your portfolio from significant losses if one investment performs poorly. Spread your investments across different asset classes, such as stocks, bonds, and real estate. This strategy can help you achieve a more balanced and resilient portfolio. By diversifying, you reduce the risk of losing a significant portion of your investments due to market volatility. Lastly, stay informed. Keep up with economic news and developments. Staying informed allows you to make timely and well-informed decisions about your finances and investments. This will help you make informed decisions about your finances and investments. Regularly review your financial plan and adjust it as needed based on the latest economic trends and forecasts. By taking these practical steps, you can better prepare yourself for a potential recession and ensure that you are financially resilient in the face of economic challenges. Section 9. Conclusion. Hope for the best, prepare for the worst. Predicting the future is impossible. While a recession in 2025 is not a certainty, it's a possibility we must acknowledge. The global economy faces headwinds, and policy uncertainty adds to the complexity. Rather than panicking, focus on what you can control. Take steps to strengthen your financial foundation. Build an emergency fund, reduce debt, diversify investments, and stay informed about economic developments. Remember, even in challenging economic times, opportunities can arise. By being prepared, you'll be better positioned to navigate the uncertainty and potentially even benefit from it. Do you agree with my content? Please feel free to post your comments, do like and subscribe to my channel if you haven't.